James Gerrish, who joins us now live from Shaw and Partners for his take on what to expect today. James, great to have you on board with us. We've been speaking about the weakness of that oil price, maybe even suggestions about the strength of the Aussie dollar. What do you put it down to, that weakness that's expected today?
Yeah, good morning to you guys. I think it is all related to the Aussie dollar and obviously the flow through into domestic commodity producers here. So, the likes of BHP are going to open down 1.2%. Relative to yesterday's close. It's obviously a combination of weaker oil prices overnight, but also that resurgence in the Aussie dollar. So that translates to a weaker open for BHP today. The banks are going to open around flat if US ADRs are anything to go by. So look, at a weaker session, spot futures may be overdoing it slightly, but again, it'll come down to what our banks do. Will we see buying perhaps in CBA for a second day? It was up 1.4%. yesterday. We've had analysts plug through the numbers around what that $700 million hit will mean, and whether or not we see buying today is obviously going to be interesting. I think we may do in CBA, guys, and the rest of the banking space.
And would you be looking at CBA for clients outside of the other big four banks, or do you think there was a bit of a short-term relief pop, if you like, for CBA yesterday?
No, I still think CBA's got far superior metrics than the other banks. Their return on equity is sector leading. They obviously traded a slight premium to the other banks in terms of price to book, so they're on 1.8 times price to book. But if you look at their price relative to the earnings, they're now sub 12, which is incredibly cheap. Everyone cites CBA and the premium that it trades onto the other banks as being unjustifiable, but they do have the metrics to back that up. The fact that they've come back and are now trading from a PE perspective at least in line or slightly below the other banks, I think to me creates a relative opportunity in CBA in sort of the vortex of all the negativity put out there. $700 million fine is it's about a 2% hit to earnings. It's worth about $200 million after tax. Above what they'd already provisioned for. So, to me, that's a good outcome from the AusTrack situation. It could have been a lot worse, guys.
Yeah. Can we talk energy stocks? The oil price overnight, yes, it was weaker. Continuing that weakness, I think it's dropped more than 8% now over the last couple of weeks if you factor in, obviously, the moves overnight. What would you be doing with some of those energy stocks? Using it as an opportunity to get in, or would you be taking some profits off the table here?
No, I think we've already sold out of our energy stocks based on OPEC commentary. So I mean, you've got to listen to OPEC when it comes to whether they're going to pump more or less oil out of the ground or release it to the market. So back when oil was trading at $40, they're saying they're going to pump less. Now that oil's rallied so far, they're saying they're going to pump more. So to me, you've just got to play that. You've got to listen to them. They tend to have a pretty good handle on the market. They control a lot of the market. I know the shale production coming out of the US has had an influence on that, but OPEC's still the biggest game in town in terms of oil. So I'd be cautious on the energy names now. I'd be on the sell side of energy rather than the buy side. We've sold out of BHP recently. Our last sale was around the $34 mark. A short-term bounce in the last couple of days, BHP, but I think it ultimately goes back and retests that 29.50 level, and that's when we'd probably step up to the plate and buy the likes of BHP and a few of the other commodity energy-related names again.
So it's taking a short-term view, because I know many people, particularly for BHP, would be looking for potential capital management options once they do finally sell those US shale assets, and that being a reason to be in BHP.
Yeah, I agree. They're obviously capital management initiatives that are likely to be rolled out. But the market's been talking about that for a very long time, James. And if you talk to analysts out there, they're now factoring that into their models. They can, we've got a bullish stance on BHP from a house perspective. But I look at short-term tactical money flow and where the short-term movements in stock prices are, and the fact that everyone's talking capital management. If they came and announced capital management tomorrow, it's going to be dependent on not whether they're doing capital management, but the size of the capital management. And they've got to go out there and initiate something pretty extreme to surprise the market on the upside. So my thoughts would be that because we've been discussing it for so long, it's on the table. I think it'll be a case of buy the rumour and sell the fact in terms of BHP's capital management approach.
What about some of the other mining stocks? So you talk about your view there on the energy stocks. What about the rest of the mining complex? How do you view it? I mean, I know that there's been these trade tensions going on and talks about concerns and the impact on demand, not just on oil prices, but on other commodities as well. How are you viewing the broader sector with obviously those bubbling trade tensions?
Yeah, I reckon you've got to be very selective in what you look at. So, I think the nickel miners look interesting here. Independence Group we've got in the portfolio. It's done pretty well in the last couple of days, but going into the financial year end, we've seen a lot of short covering in stocks that have heavily shorted. Independence Group is an example of a stock that's heavily shorted in the retail space. It's sort of lagged the underlying nickel price in recent times. Western Areas looks reasonable. Iluka's pulled back in recent times. We don't own Iluka yet. We're waiting for lower prices, but that looks like an opportunity. Bought some Fortescue Metals the other day. That, on a relative valuation perspective, I know iron ore's come under a little bit of pressure, but from a relative valuation perspective, I think Fortescue looks reasonable here. So, look, we're out of the larger Rios, BHPs at this point, looking to buy weakness. But again, we're sort of nibbling around the edges on some of the mid to large cap plays. I guess Independence Group, Fortescue we've got in the portfolio, and Orocobre in the lithium space we hold in the portfolio as well.
So looking at weightings, James, I mean, you guys had been quite openly overweight energy and mining. Does that remain the case? Obviously, perhaps not energy, but is it still the case for miners? It's just different commodities that you're exposed to, or are you now underweight miners? And if so, where have you put that money to work in other parts of the market?
Yeah, so I mean, look, you think about the longer term drivers of the commodity sector, and we've seen coordinated global growth, and we all know about that and what it's having. We're seeing global interest rates go higher, etc. So you overlay a chart of BHP with the US 10-year bond yield, and you have a pretty high correlation. Interest rates go up, commodity prices go up. There's a whole number of reasons around global growth, etc., that supports that correlation. In the last week or so, as we've made mention of, the 10-year yield has pulled back, and that's why commodities have pulled back. There's the overall trend is higher, but you're going to get ebbs and flows. So my approach in the market, and it's around our portfolios. It's not necessarily around how Shaw manages the wider portfolios across our group. But our approach is sort of taking money off the table when things look overextended, and buying into weakness with the overall view that commodities are going higher over time. So still bullish commodities, still bullish energy, but right now we've taken, as you said, money off the table. We're in the banking space. We've added there a little bit too early, I think, in our portfolios. But to me, it looks from a relative valuation play. It looks like a smart play to be in. You look at property in the last little while. Property was on the nose for a long time, but property has run pretty hard in the last month when everyone dislikes property. So going against the grain or the trend is sort of how we play it here, James.
Speaking of property, Vicinity Centres was one of those yesterday that we were discussing. What is it? The country's second largest retail landlord, obviously dramatically exiting or ramping up its strategy, selling out of $1 billion worth of those smaller malls in the next 6 months or so. You've obviously had a chance to really delve into the detail and crunch some of those numbers. I mean, do you think that was a good move from Vicinity Centres?
Yeah, I like what they're doing there. So we own Vicinity Centres in our portfolios. They were trading at a pretty big discount to their net tangible assets, so trading at a discount to the assets. Those assets that they're talking about selling, they weren't being valued by the market. So if they're not seeing value from the market through their share price, they need to go out externally and realise that value. And they're pretty confident they'll get book value for those assets. If they get book value for their assets, it's going to be a positive for the share price. They still trade at a 10% discount to their assets. They were at about an 18% discount to their assets when they were trading around $2.50. So if you can go out there and buy a stock trading at a discount to the underlying value of its assets, and you've got a management team in there that's focused on realising or bridging that gap between assets and share price, then to me, that's a reasonable investment, and VCX has been a reasonably good one for us as well.
All right, James, have a great session. Got to leave it there. Thank you.